Good afternoon. My name is Campbell McCrary. I'm a Vice President of Capital Markets at Amvest Capital in New York. Welcome to the Amvest Capital Inc. live webinar with Kerr Mines. Kerr trades on the TSX Venture as KER and on the OTC as KERMF. We do hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in, as some of you have already done, and we'll get to the questions in real time. Amvest is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource space. Please note, very important, this call is for informational purposes only. We're pleased to have with us today Giulio Bonifacio, the CEO and director of Kerr, has over 30 years of senior executive experience and has had senior executive positions in the mining industry, and is the founder and was the CEO of Nevada Copper. He's also instrumental in providing over $700 million of capital to projects of merit, while having led to the efforts at every stage of development, from exploration, production, permitting, and construction. He is a CPA with extensive experience in the capital markets, securities matters, project finance, and M&A. He's had senior roles with Getty Resources, Total, and Vengold. Again, following the presentation, please send in your questions and we'll try and get to them. Julie, want to share your screen and we'll get started. Okay, we have audio and video, so tell us what's going on in Arizona, bud.
All right. Well, thank you very much, Campbell, for the introduction. One slight correction: Kerr trades on the senior board of the TSX and has done for a number of years. As you can see by the first slide, it's an advanced asset. I've got familiarity with the asset from a long time back, and I think there's just a fabulous opportunity. But it was really about how do you take this project and get it to the next stage. And so we'll take you through that slide by slide, and then at the end we can answer any specific questions that you have with regards to that. One of the first things that we did, let me just go back to the first page. One of the first things that was done over the last 18 months was looking at the existing permits, and getting a project permitted in the American Southwest is not a simple task. I've got experience with both what we did over at Nevada Copper with Pumpkin Hollow, but also with Copperstone. And there were some modifications that were needed that would allow us to increase our daily throughput to 600 tons per day, but also apply cyanide so that we could leach to a doré or a gold bar. And so that opportunity is something that just came and was approved in the earlier part of 2020. The disclaimer language, there's going to be obviously forward-looking information within the discussion, as you'd expect. And this is in great part why this statement is required. But, of course, for any investor or prospective investor, you really do need to get a sense of why this is a compelling opportunity. And when you look at our share price and our valuation, I think, quite frankly, it is a very compelling opportunity, both because of the upside of the resource, the ability to add mine life, and the ability to get back into production for what is a modest amount of capital. Slide 3 is more background in terms of what the share count looks like at 346 million. There's a strong holding of that share position within the directors and officers, and a number of funds and family offices have accumulated a position over the last couple of years. And recently, as of August of this year, we closed a bought deal financing for $5 million. It was well oversubscribed. We had a book that was 2 to 3 times over. We did not want to dilute it at that price point, but felt compelled to put capital in place so we could advance the project. Current cash balance is more than adequate to execute the short-term plan. There is also a lending facility that's potentially available to us, subject to achieving certain project milestones, inclusive of mine life extension, detailed engineering, and EPC pricing. And that's something that we're working on, but we're also considering other options. And so you might see us look at other forms of third-party debt or possibly some other forms of funding, with the idea of mitigating, minimizing any further dilation. And bear in mind that when the directors and officers own 31% of a company, dilution is first and foremost. We're very, very cognizant of that. I stepped into Kerr last year, blessed in terms of the people that are involved, I will say that. But with any mining project, going from a feasibility study to execution does require further work, because study work is exactly it. Advancing the engineering, getting a better handle on what optimization opportunities might exist were pretty key. So came into a company that had Martin Kostiak, who's a proven miner, mine builder, Dave Thomas, formerly with Newmont, and so very pleased with the team that we have, albeit core group. We have miners on site. We've got underground development, 4,300 meters of underground development. So, of course, based on that alone, and to ensure that we continue to dewater, we have to have staff on site that deals with that. But it has allowed us an opportunity to look at the project from the feasibility study and make some real improvements, and pretty pleased with where we sit today, and very, very excited about what the drilling program will bring forth. Location. You know what? Location matters. A project in the American Southwest of this size is going to be of great interest in our sector. The number of ounces that we speak to globally, 400,000 ounces, proven and probable 175,000 ounces of 2P. Those numbers will change. Those are outdated. They don't incorporate the drilling that we did last year, nor does it factor in current parameters that have changed. But as you can see on slide 5, the location in the American Southwest is without doubt something that is of great value to us in terms of existing infrastructure. And if you looked at the existing infrastructure to replicate that, you're probably north of $100 million. And that's also what creates the opportunity. That's why we can get into production within a relatively short period of time, subject to getting the funding. And so we'll talk about what that might look like as we progress forward here. Going into slide 6, this is more motherhood in terms of some of the things that were actually accomplished. And when you look at a share price, that in itself isn't how you should gauge it. It was really about preparing ourselves to get us to this point. And, advancing the metallurgical test work, understanding that with either flotation to leaching to a doré, we get a very good recovery, but that also creates an opportunity relative to capital. But that doesn't rule out whole ore leach and what that might represent. And the recoveries with a whole ore leach scenario, albeit more costly from a capital perspective, are very significant at plus 95%. Last year's program, if you look at some of those drilling results, and we will touch on them, you can see we're very, very significant. So does that add ounces? By all means, it adds both. It adds both resource ounces in all categories, but it also looks at extension of mine life, which is previously published at 4.5 years. And that's a bit of an issue that has to be looked at. We're well beyond that, but when people look at Kerr and they look at Copperstone, they think that there's a finite mine life there at 4.5 years. That is not the case. And the intent clearly is to do the drilling program, update the resource, the reserve, and put out the updated information. Detailed engineering on the process side. So when you look at any mine build, especially if it's greenfields, there's a lot of issues that go into that, and there's a lot of execution problems as well. The benefit of a Copperstone is it is built. It's a restart. The two biggest cost areas would be the process side in terms of what we ultimately put in place relative to, is it going to be purely flotation at 600 tons a day, or are we going to look at a phased approach to flotation to doré or whole ore leach? We're looking at that currently. We're leaning towards the latter, but we'll have a better sense of that. But we know arguably what that's going to cost us, and so it's not a big cost item. Again, it's a restart. The other biggest cost center clearly would be the mine development, but we've got 4,300 meters of mine development, so we have a good handle on what it's going to cost. The geotech competency of the rock speaks for itself. We understand what we have, and again, it's not a new build. There's a wealth of information that's been accumulated over the last number of years, and plus $100 million spent. So the next order of business for us is, on top of adding ounces, we want to advance the costing, get to EPC pricing, which is plus or minus 5%, as opposed to what you typically see in a pre-feasibility study. We've identified plant and mining equipment that we need for this purpose, and we're in vast discussions with contract miners about what they can do for us, and within that gives us a firm costing and estimate of what it will cost us to advance the work that's needed to move the project into production. But you'll hear me say it a couple of times, that anytime you can take a project into production subject to a proper funding package within 12 months, I think speaks for itself. And I think you'll see some success with us on a go-forward basis as we start continuing to de-risk it and put forth a strategy that shows both an addition of ounces, but also production in 2021. Looking at sort of the cross-section on slide 7, past production, 500,000 ounces in the late 80s by way of an open pit, nearing 2.5 to 3 grams. That in itself is pretty significant, very profitable operation with gold when gold was trading well below $300 an ounce. And so when you look at what we're looking at doing, we're tapping into the base of the pit by way of underground development. We've got 4,300 meters of underground development. There's good open extent. Now, when you're drilling an underground deposit, you really have to measure your capital versus your mine life. And you know, I'll readily say that we're at 6 to 7 years. We think arguably potentially more on the back of this drilling program. That is more than adequate to justify a build on this project. The intent, though, is also to drill it from surface. When I say drill it from surface by way of the base of the pit and explore further what ounces we can add. Because by far, when you look at the historical production of 500,000 ounces, you look at what we currently show as a published 43-101 resource, 422,000 ounces. We think that there's a lot more to chase after. Some of that will be in the inferred category, some of it in the M&I category. As we continue to develop the underground deposit, then we'll look at conversion appropriately by way of delineation, development, drilling. Slide 8 gives you a bit of a snapshot in terms of what we're looking at. At the bottom, as you can see in those 3 brown boxes, inferred M&I, which gets us to about 420,000 ounces, and then proven and probable at close to 7 grams, which is a very high grade system. And so that in itself is something we're pretty pleased by, because that just creates more margin. If you look at the right of this slide, you'll see that there's an ability for us to continue to have success. Last year's drilling was focused in on the area that's been circled in red, 2019 resource expansion program underground drilling area. But there's 4 different zones that we speak to: the A zone, the B zone, the C zone, and the D zone. Predominantly all the development is in the D zone. The drilling in the A and the B and what we can add by way of the footwall and Copperstone fault is what we're really excited about. So you'll see us add ounces, which from my perspective will change the value proposition. And when you look at a Copperstone, clearly far more advanced, an ability to take it into production, and just a lot of good upside relative to the number of ounces we can add to it by way of the further drilling that we do on this project. Slide 9 is just a summary 43-101 report. Again, 4.5-year mine life, calculated at gold when gold was at $1,250 per ounce or around that range. Slide 10, I think, is a very key slide in terms of what it speaks to. It speaks to the method in which the reserve was calculated. It was done on a very conservative basis. It was based on tightly defined mineralized domains with a very conservative capping strategy with a search radius that was pretty modest. And so what that does is it tells us, hey, gosh, if we were to adjust the cutoff grade, look at the parameters, look at the drilling we did last year, have we added ounces? And the answer is yes. Do we have something that we can point to in the public domain that's 43-101? No. The reason I get asked all the time is we want to complete this next phase of drilling. We were delayed in this phase of drilling. By all means, we had a high wall localized failure at the beginning of the year. That basically gobbled up a good amount of cash that we were allocating towards a drilling program that we wanted to start in Q2. We have gone out and raised money by way of a bought deal financing, well oversubscribed. We also hope and expect to get money back from the insurance provider that will simply add to our current treasury. Now, when we go to slide 11, kind of captures what we're attempting to do relative to this program. There's assays currently pending. You'll start to see as a current investor or prospective investor that there'll be a lot of news that gets put forth by Kerr, both in terms of the assays that we're currently expected to get back here in the next 2 to 3 weeks. Now, I will say very clearly that bandwidth for assay labs has changed dramatically. There are delays. They're very, very busy. And so we're pushing it as hard as we can. We hope to be in a position where we can report by the end of the month. It may trickle to the beginning of November. I don't expect that to be the case, but again, there's certain areas within our business we can't completely control. But I will say once we start in, you will see a series of news releases that report assay results as we continue to drill this project out. And bullet point number 2 is key. There'll be a fair bit of news up until Q1 2021 specific to the drill program. Conversion of inferred to M&I, what that ultimately does to our reserve, that'll all be factored into an updated resource that we put out likely at the end of this program. I was asked, when are you going to update the resource? Essentially we're dealing with timelines that were previously put out that were probably not as realistic as they could be. The reality is we want to drill the 10,000 meters, capture the drilling from last year, update the resource accordingly. So that'll be sometime in Q1, Q2, I'd say the beginning of Q2 at best. But that doesn't mean that we don't stop on other activities. This really is more about ounces, the value driver, and being in the business for such a long time and and taking Nevada Copper from what was an early stage project to something that is currently in production. Now, whether I agree with what's happened here in the last couple of years since I retired from Nevada Copper is not the point, but it is fully permitted. It's going into production and will be wrapped up by Q1. Looks very interesting from a value perspective. You can look at it, but when I was there, I was very mindful of dilution. We had 80 million shares outstanding, and I was there for 13 years. And since that point in time, another 1.4 billion shares have been issued. And that's why that price point is languishing where it is. But that as an aside, copper prices did what they did. But I want to be very clear that, this is a project I've stepped into in a company, and I've been very pleased with the folks that I'm getting to work with on this. But it is really about, okay, because we benefit from a project that is arguably a restart, what are the benefits? What are opportunities from a funding perspective? And I do want to speak to the three-pronged strategy. It's adding value by way of the drill bit. It's taking the project into production on the back of a properly defined funding package, and that may or may not be a Sprott lending facility, it may be another facility, but also then looking at other opportunities from a corporate perspective. Very few of these projects and companies that you see today, you look at some of the valuations, and I constantly get asked, well, look at their valuation, but much of it has to be backfilled. It's going to be pretty hard for some of these companies to support their valuations, in my view. But this project, with ounces to add, production in the near term, other opportunities, I think will garner value for all shareholders going forward, including some of the legacy shareholders that bought into Kerr a number of years ago, and I completely appreciate why they've had some challenges. But it is about defining what we currently sit on, optimizing. I've been here for a little bit more than 14 months. I think we're now in a position that you'll start to see this move forward appropriately. And it's taken me, frankly, a bit longer than I would have liked, but such is the market, and things like a localized high wall failure that delayed the commencement of our drilling program. I cannot control Mother Nature in simple terms, but we did do what we needed to do to correct it. We'll get that money back from the insurer, but we also went out and raised money at 14 cents, and as painful as that was, it also allowed for a number of new shareholders to come into the story. And our share registry, I think, is going to continue to improve here with notable investors and funds that will support this story going forward, because the valuation is well below what it should be. Slide 12 is just to give you some sense of the number of targets. And one of the questions I got asked is, why did you want to step back into it? Well, I stepped away from it because I wasn't pleased with what was happening by way of the predecessor company. I just think there's a great opportunity. 500,000 ounces historical production. What Kerr has currently, which is 420,000 ounces, what we can add to it based on the drilling last year, based on updating the resource, but then chasing other targets. It's a detachment fault system, so there's no reason to think that there's not going to be parallel structures that follow it. There's some fantastic intervals. And when you look at the market today, it is rewarding drill results. But, if we can drill near surface, multi-gram intercepts, I think that'll drive value from another perspective. But there's just too many opportunities here relative to an existing underground deposit, the ability to add further ounces, and thirdly, the ability to take it into production, and fourthly, the fourth prong, other M&A type opportunities that allow us to continue to leverage value, subject to dilution, and that's something we're very, very mindful of. Now let's look at some of the drilling that was conducted last year, and you can see, and this was done by way of underground drilling. We within the underground development that we have, we put in drill stations, simply notching out appropriate stations for purposes of underground drilling, not at a big cost, as you'd expect. We're not putting in defined drill stations, and we were able to put in some drill fans that came back with some fantastic values. And when you look at hole 182106, 17 meters of 40 grams, and within that 3 meters of 98 grams. That's a very significant grade, but throughout you can see fantastic results all the way through. So did that add to our resource base? By all means. Did it add to our mine life? It did to a certain extent, but was all of this going to be picked up as M&I, which is what you need to convert to 2P, proven and probable? The answer is no, and any miner knows that. But let's look at slide 14, which again speaks to it. There's a good open extent within the project underground, as I've previously highlighted on the previous slide. When we look at the drill stations that were put in, and you can see there's several, and you look at how that correlates, but hole 18, and I do want to go back to it because it is a very significant hole. Out of drill station 1821, I'm going to go back here. You can see where I sit. We drilled beyond the mineralized domains, and here's a good visual of what that looks like. These were defined mineralized domains that were used for purposes of the resource calculation. As you can see, it's inferred ounces. So did we add inferred ounces? Yes. Did we step out beyond the defined mineralized domains and come back with some fantastic values? We did. So I think that's a key point to focus in on. We want to go back in with a core rig as opposed to an RC rig. That'll define it to a greater extent for us. And so ultimately on the back of this year's program, which will be 60% allocated to expansion, 40% to M&I, inferred conversion, and mine life extension. We do want to speak to what we think arguably could be 1 million+ ounces. And I'm not going to say that's an easy thing to do, but on the back of a successful drilling program, we're going to get awfully close to that, we believe, and that's what's going to garner real value. And again, do not understate the fact that we're fully permitted, and the ability to pour gold on site with the application of cyanide is a key modification of the permit that was led by, and the modification was led by Martin Kostek, who's been with Kerr for the last 3 years and has done a very commendable job in terms of advancing the project and de-risking it, which is really what needs to be done. Another drill station closed view that you can see that again points to some very good intervals and some very good grades. In terms of infrastructure, I think the visual gives you a good sense of it. The first slide also gives you a good sense of what exists, and the fact that we have 4,300 meters or 4 kilometers of underground development, and the geotech competency is very good, is a huge plus for us. And the permit modifications that started in 2018, and there were minor modifications from a pre-existing BLM mine plan of operations. We got that in the early part of this year. Now it's really about executing on a plan that gets back to that 3-pronged approach: add ounces, add mine life, look at your opportunity, and figure out what the optimized scenario should look like, and whether that's going to be flotation and leach to a doré, or look at whole ore leach. We're looking at it very closely and think there's some really good opportunities. This to me is one of the key slides, and it speaks to the economics. And is it 43-101? No. Is it based on a PFS and baseline data that we're very comfortable with? Yes. Does it advance that to what is more advanced than what you would typically see in any type of study? In my opinion, it does, because it's based on areas that we can define very closely. What is it going to cost us to restart the mill at 600 tons per day? What is it going to cost us to move to whole ore leach, or simply look at float con to a doré? What modifications to the circuit? What is it going to cost us for mine development? The mere fact that we've got the benefit of historical mine development, and with Martin's background, my background, at Pumpkin Hollow, we sunk a 2,200-foot production size shaft, 24-foot diameter. So I do have a level of experience of what that looks like. And I very much understand that it's really about getting it to the next level and defining it and doing that in a way that gives you some firm numbers by way of mine contractors. And we want to look at contract mining for the first part of this operation to de-risk it, and then arguably at the right time move across and look at owners mining, but not initially. But if we do that, that's another opportunity. This model is based on contract mining for the first 4 years. If you look at it and you look at what was put out, the 2018 PFS is a project that would generate good cash flow. CapEx came in at about 23. We've been able to lower that. We still think the range is 20 to 25. We've had to modify, but bear in mind, when these numbers were put forth, that was 2018 and we're in 2020. So there's going to be some additional increases that you're arguably going to face that you can't control. But again, we still think we're in the $20 to $25 million range. Our all-in cost below $1,000 is very commendable, and will drive what is a very short payback, less than 2 years. If you look at the internal rate of return, 81%. You look at our operating cash flow, you look at our EBITDA. Note 3 is a key slide. At $1,500 gold, we're looking at about 20. As we ramp that up at $1,800, assuming you believe that gold trades at $1,800 and above, we, in my view, think that is going to be the case, but we're not going to make our decisions on that basis. You can see that the cash flow that gets generated based on an 8-year mine life is pretty significant as we continue to add to mine life, and there's no reason to think that we can't. If you look at underground mines worldwide, the typical rule of thumb is 8 to 10 years to start. There's no reason to think that we can't replace what we mine out, but that comes in by way of underground drilling and as well as underground development, so you can move it into the 2P category. This runs at $1,500, right? So now if you're to use your imagination and look at what it would run at $1,800, I would say that conservatively, payback, the IRR will still come in that range, if not above. I just don't want to speak to that at this point, but we do know what those numbers potentially look like. And it all gets back to having a very clear path forward, and that is adding ounces, adding mine life, optimizing. And did we take a bit longer than previous management had initially anticipated? Yes. Did that cause us some angst? Yes. But that's what creates the buying opportunity. There's a lot of new shareholders that have stepped into this with a fresh look and look at it and completely appreciate the value opportunity. Unfortunately, many of the investors that have sold here over the last 12 months are folks that predate me, and some of them have stayed in appropriately so, and some have made the decision to move on. But you're not going to find many projects like this that have been de-risked to the extent that this one has been. And I think that in itself is really what should be looked at today, moving forward, and what can be achieved in the next 12 months. Slide 20 is more of we call it a report card of sorts in terms of what we think we can execute on. And I have no doubt that we'll be able to hit each and every one of these points. Some of them we've already hit, such as the final permit modification from the BLM and restart of operations. But, again, restart of operations, that doesn't start until we have a proper funding package. And then one has to look at what we look at from a share count perspective. And when we look at our share count, we simply do not want to issue more shares. We've got, I'm going to jump right back here. If we go to slide, excuse me for a minute, we go to slide 3, 346 million shares. We've got a number of warrants that are outstanding. Some will expire in November. They're all priced attractively. If we come out with meaningful drill results, a lot of the warrants are held in very strong hands, which is a very positive note to highlight. But if we come out with positive drill results and come out with an appropriate funding package, which, of course, with my background, that's what we've been working on. Clearly been working on it, but we're not going to take high cost money that doesn't make any sense. We're not going to take money that's got too many hooks in it. And we're not going to be basing it on a pre-feasibility study that is frankly outdated, but it is without a doubt a good baseline to use for purposes of doing the work that we're currently doing. But any funding group is going to look at our current internal optimization work appropriately for the market though, and investors. We will come out with an updated resource reserve and as needed, updated set of economics. And so that is coming, but that's not going to be the bottleneck in terms of the timeline. I'm convinced we can get there at some point before the end of the year. Now, again, there's work to be done, but we're getting a lot closer to it. And, have there been some challenges? Without a doubt, there have that have resulted in delays. But as of today and going forward, with the number of things that have been dealt with, when you look at the mining team that we have and the core group, very competent. I'm very, very excited about what this potentially looks like over a period of time. And when you trade 40 to 50 million shares post-financing, that's an interesting thing. But of course, you're going to have some legacy investors that come out, but it's really about the folks that position today and moving forward. So on that, Campbell, I guess I'll turn it over to you for questions that we might have. I hope I didn't take too much time to give you a general overview.
No,
but
that's good. That's good. I know you want to just focus forward, but just for the benefit of people who are new to the story, haven't been here for a while, can you thumbnail summarize the history of the asset and the company, sort of say the last few years, and then your transition into the company? And
yeah, no, I will. That's a very, very good question. It really gets back to 2001. A company called American Bonanza acquired it out of bankruptcy, did a wealth of work, probably spent close to $70 million on it. I was involved with that, but around the same time founded and created Nevada Copper, so moved in a slightly different direction, but also looked at the project and didn't really think that it was being advanced appropriately. But that's in fairness to what occurred then, that's an easy thing to look back at. But unless you do the appropriate delineation, development drilling, unless you have appropriate ore controls, you're going to face dilution, and that's arguably what happened. And there were some cost overruns, and so I stepped away from that. But for me, it's a project that is yet unfinished, and that's why I stepped back into it. I have plenty of opportunities, but I really want to see Copperstone advance to the next stage, and that's production, and also demonstrate that it's more than a 400,000 ounce resource, which it is. And so that's kind of why I stepped back in April, May of last year. And as noted earlier, blessed by the team that was put in place by Claudio Trivella and the chairman and vice chairman. And so they're a committed group. We know what we have to do. We're not happy with where we sit today from a valuation standpoint, but value is driven over a period of time, and anyone that can pay attention to the data will appreciate that a number of boxes have been ticked on this project, which is why I stepped in. I also I've written sizable checks. I'm not just playing with other people's money. I've written about $700,000 on this and happy with that investment. Do I do this for fun? I do it for the sole purpose of making a return. And, sure, my cost base is in the 13, 14 cent range. But with that said, that's the opportunity. That is clearly the opportunity. Next question, Campbell.
Sure. You've inherited some of this capital structure. Any thoughts on reverse split, and then just your philosophy or approach to dilution?
Well, I mean, my history speaks for itself. 13 years later, Nevada Copper had 75 to 80 million shares outstanding and raised north of $400 million. So I'm sensitive to dilution. I'm sensitive on Kerr as well because I'm not the biggest shareholder, but I've got enough of a position at close to 7 million shares in options and warrants. I would ideally not see us issue any more shares. Now, I can't guarantee that. I mean, I will say to you very clearly that if our share price was trading where I think it ultimately gets to, then you might consider doing further equity issues. But, at this price point, no desire. So, that has allowed us to really think very clearly about what the opportunity is, but also what we have to do as a company. And then when you look at the ownership from the chairman and the vice chairman, that represents almost 30%, 29 to 30%. And so we all have enough, to use an overused term, a lot of skin in the game, these guys specifically, but I also have a fair bit of skin in the game. Dilution is something that gets created by way of taking projects forward to the next stage. But the benefit on this one is the fact that, it's a restart for a modest amount of capital, and can we bring that one forward? So I'm not going to promise or guarantee that we never consider that, but maybe at some future point, if it's appropriate and our share price is where it should be, maybe that's an opportune time to look at something if you're going to do a merger with another like producer. I also do believe that gold companies and the market will pay you for leverage. They will pay you if you have more than one asset. They'll pay you if you have more than 1 to 2 to 3 to 4 million ounces. So because this project is fully permitted, de-risked the way it is, you can bet on the fact that we're in a lot of different discussions, but we're not going to give it away. It gets back to the ownership from the directors and officers, specifically the chairman and the vice chairman. So, again, we know what we have in front of us. It is really about now doing more of these. I haven't done any of these really other than the presentations as part of the financing that we completed, and that was, well oversubscribed for obvious reasons. Now it's about, more presentations, market awareness, doing a lot more of these, but now there's going to be a good level of news flow, both in terms of drill results, what we're doing on the project, and arguably maybe by the end of the year, you'll see us execute on some form of funding package that demonstrates that we are going to get into production by next year. But, the mere fact that we can within 12 months is a real benefit. The mere fact that we can get close to the numbers that you're seeing here and generate that type of cash flow can't be overlooked. Now, I'm not going to suggest that that isn't subject to execution and the work that goes into it, but we've studied this project well enough and we've de-risked it well enough that we're pretty comfortable that these ranges that we're putting forth are reasonable. I mean, for example, if the capital goes up from 19.9 to 23 to 25, the mere fact that gold's at $1,800 offsets that, right? The mine life at 8 years, if we get beyond that, what does this look like? I mean, and so the EBITDA multiple and how you value these things changes dramatically on execution. So, for those that are shareholders, I think you do very, very well, but it's really about, staying patient with respect to where we sit and looking at it over a shorter period of time, because this is not an early stage resource project that is hoping to put out some positive drill results, then take it to a loosely defined economic study, then get their permits, and then move to study work at a more advanced basis, such as a PFS or feasibility study. It's a project that is arguably ready to go within a relatively short period of time. As you can see by my gray hair, I'm not doing this over a long period of time. I think I can get there in a pretty short period of time. Has it taken me 6 months longer than I would have liked? By all means, it has. And there's certain events, as I said earlier, such as that localized high wall failure that drove that delay. But now we're well positioned to move forward appropriately. Next question.
Sure, and then I'll give it to Gabe in a second. Did I understand correctly that you hope to have a financing package by year end? Is that what you said?
Well, I mean, simply put, you set targets for yourself, and so there's a lot of discussions that are ongoing on a pretty advanced basis, right? Whether we can get there is something I'll never guarantee. I'm a serious mining executive. I know what it looks like, and from the time that you start talking to the time that you get to closing, and you execute on the definitives, it does take, it does take time, and there's always areas of contention. So ideally we get there by the end of the year. That's my target.
Yeah.
If we get there by the end of the year, then you'll see both value add by way of the drill bit and a project that moves to production within a short period of time that generates good amounts of cash flow, which then drive further value.
Pass it to my colleague, Gabe.
Hey, Giulio, thanks for the presentation. This is a good slide because I was going to talk about this slide. So we can stay here for a minute. The increasing cost, or the increasing rather gold price, does that just increase the economics, or does that also increase the mine life? So let's say if we go to 1800, do you get a 9 or 10-year mine life out of that because you're able to grab more resources, or is it just the economics of
well, again, Gabe, that is a good question. It kind of touches on that slide that I had earlier that spoke about the reserve calculation. And so clearly as gold goes higher, the cutoff grade changes, so you're going to bring more into the equation. Based on what we see conservatively, we think we're at 6-7 years. That's not including last year's drilling. So it's a bit of a blend. It's really about cutoff grade and what that captures. The other thing that folks don't look at, because you have to calculate, you do by way of kriging, but capping strategy, if the overall average grade on this deposit is 6 grams, and for example, we drilled an interval that had 3 meters within it of 98 grams, and within that 40 grams, we're not taking it at that value, right? We have to cap it. And so defining that, so what you'll find is when you advance it further and you start mining it, you'll have arguably some good grade reconciliation positives that come from that, right? So what we're trying to do is mitigate this and come up with what is a conservative model that says, hey, based on what we see, we think it's, within 7 to 10 years of mine life, we'll add more appropriately. As we start mining it, there's going to be some grades that probably exceed what we typically have in our defined model. And so that'll create benefits. And so it's a bit of both, gold price driving the mine life add, but also the drilling program last year, and also what that does to the overall project in its entirety in terms of, paybacks and things like that.
Sure. And so, and on that drilling program, are you seeing sort of expansion of the ore body? Are you seeing it mostly at depth or along strike? Where can we expect to see expansion of the ore body?
Well, we're drilling along strike, and most of it will be the initial drilling, if you will, is on surface at the base of the pit. So most of that will be resource expansion. That is our focus, because when you look at a project like Copperstone, it is, and I always got to be careful with how I phrase this, but it's going to be significantly more than what we have published. And so it gets back to the value drivers. And one of the critiques, and I get this completely well, because Group Nevada Copper is pumping all from 3 billion pounds to 12 to 13 billion pounds of copper, and that included gold and silver. But I don't mean to always get back to that, but the drill bit is a fantastic way to add value. And so when people look at this again on the updated resource and go, hey, it's not 400,000 ounces, it's closer to 2x. Let's just use that as a number for discussion purposes. Maybe it's a little bit less. Mine life is this. I think that's what's motivating us to do a little bit more resource expansion as opposed to mine life extension, because we already know on the mine life extension we're at 6 to 7 years, so we think we're pretty much there. But we still want to look at a split that's like 60-70% resource expansion and 30 to 40% mine life extension. And so most of the drilling from surface at the base of the pit is going to be done by way of an RC rig, because it's really going to test out the ability to add inferred ounces. All the drilling from underground, which we are looking to start here in the next 2 to 4 weeks, will be by way of a core rig. And so we do want to go back to, for example, it's pretty exciting to go back to slide 16. I don't know if you can see it. Hopefully you can, but
yep.
You can see we stepped up beyond the defined mineralized domains. If we can continue to chase that and define that more tightly, then that is going to be a good win for us, right? But underground is underground, and you're not going to get to it until you actually drill it appropriately. But by all accounts, with what we can see currently, and we've got a very strong team on site and external advisors as well that really help us a whole lot. With what we see, this could be a real win for us. But I don't want to be cavalier on this comment. I do find it interesting how certain companies trade up significantly because they have a tighter share registry, but they trade up on what are intervals that are significantly lower than these, right? So that's also part of it. Put this back on the map in simple terms. speak to what it could look like and let people make their assessment. And then, for those that do step in and those that are currently shareholders, give us a bit of time to execute. And, for those that opt not to, many of them have already started to sell. And you can look at if you look at our share price chart, you'll see that it's traded sideways on big volume. That's a good sign that it's going to gap eventually, right? We're cleaning up that share structure. And, it's not a brand new shiny car like some of these deals are with a tight structure. It's a company that's been around for a while. But, we're working through it, and that chart is something that folks should pay attention to, because it does point to why it arguably goes higher on the back of, not for anything other than value add. And the value add is add ounces and demonstrate a clear path. If you do that, that's what drives the value equation for all prospective investors.
Just a couple of quick ones. About the tax pools, do they expire at some point, or how long are they good for?
Well, that gets back to my history, and I'm a CPA. Back in the day, I was a CFO, so I understand cross-border tax. And I think the folks at Kerr probably didn't completely appreciate that. If you look back at the history of American Bonanza, and so it was American Bonanza, wholly owned U.S. subsidiary called Bonanza Exploration. Kerr rightfully so acquired American Bonanza. So Kerr, separate to American Bonanza, sitting on significant loss carryforwards. But putting that as an aside completely, specific and contained within the U.S. subsidiary and the American Bonanza company are significant tax pools that were generated by way of all the study work, all the drilling, all the infrastructure that you see was put in place by American Bonanza. So doing some cross-border tax work, making sure those returns are filed appropriately, there's not going to be a specific restriction on those pools because they were spent on Copperstone. That's not even layered into the model. Now, you shouldn't layer it into the model until you do the tax work, but that's on the docket. That's really about bringing in the tax guys, and I do know a little bit about tax, enough to be dangerous at this point because it's been a while, but I also know where those pools sit, and if we have to go back and refile some of the tax returns, and that's really more highlighting, hey, there's another opportunity that we don't even get any value for, right? So you can add it all up, you go, sunk cost, restart, ounces, tax pools that drive a pre-tax model that is going to be awfully close to your after-tax model. Also appreciate that under the Trump regime, the tax rate went down to 21% corporately. There's a lot of opportunities here that point to numbers that you can look at and feel pretty comfortable with. And not many projects will generate that type of operating cash flow for what is a very modest amount of capital. And when you ask, and you probably will ask, Craig, because we know each other from a long time back, the 1.6-year mine life payback really gets back to mine life payback, but also there's going to be sustaining capital that we incur to continue on with the development. So it's really that balance that pushes out that payback. And you want to do the sustaining work appropriately, and that means drill it further from underground for oil control reasons, drill it to expand it, but also the mine development is required to be able to convert the inferred into proven and probable.
Yeah, and like you mentioned, we have known each other for a while, so it's good to see you here. And just wanted to maybe ask, what has your experience been? You did a great job moving the permitting process forward in Nevada. How are you seeing working in Arizona? And then as it relates to permits, where
well,
the
a bit of history. We permitted what is the first copper project in the United States. We did it by way of a bill before Congress. I had a gentleman working for me that did an exceptional job, Tim Dyer. He's still there. But prior to that, I was also involved with the initial permitting on Copperstone. So I do know a lot about permitting and what it takes in the American Southwest. And I will say simply that if you're not dealing with the U.S. Forest Service or the U.S. Corps of Engineers, you're not dealing with a 404 permit issue. It is a pretty seamless process. But more importantly, or equally importantly, is the fact that if you have opposition like certain projects have, you look at the Rosemont project that Hudbay acquired, you look at what's going on with Pebble, that opposition, the fact that you're dealing with the U.S. Corps of Engineers, you're dealing with a 404 permit issue is a challenge. This project, the modifications led by Martin Kosiak, our president, exceptional job because he had the foresight to realize that we don't want to ship out a float concentrate. Now, can we? Of course we can. That comes with offtake parameters, logistic issues, but if we have the flexibility of bringing in a hole or leach scenario that increases the ability to improve our overall recoveries, or arguably you look at a lower capex by way of moving from a float con and leaching that float con to a doré, that's another opportunity. But that is where this is going to go, arguably. But But that drives the numbers too, to a certain extent. So that, that's why I'm, simple terms, modestly hedging my bet. It's a modest delta, right? If it's, I say 20, but if it's 20 to 23, if it's 20 to 25, because we want to do a whole or leach, I've got some movement in there based on the gold price, based on the cutoff, based on certain other variables, based on mine development costs that are pretty much conservatively calculated, right? But that's on the back of previous estimates from a mine contractor, not factoring, not previous estimates that are loosely defined, which is what you typically see. And, with the gray hair that you can see, I will tell you very clearly that going from a feasibility study to execution, that's completely different. It is different. And people that assume that that's not the case, unfortunately are rudely awakened when they see companies come out and they see CapEx blowouts. Now, you're not going to see a CapEx blowout on this because what are the two biggest cost centers? Restart of an existing mill, and we've defined it with FL Schmidt, and we're looking at other groups as well. And that's modest by comparison, at anywhere from $2 to $4 million, depending on what we ultimately choose to go with. Maybe a little bit more if we go whole or leach. And then you look at mine development. That's based on a per meter number that a mine contractor is going to provide. And the mine contractor, because you want to have contract mining initially, is going to bring on the equipment. So that's the opportunity. There's other variables within that says, hey, if we move to owner's mining, then is there an opportunity for us to organize a purchase of that equipment and or lease it appropriately from the contract miner? Of course there is. And those are the kind of opportunities that we're looking at. Next question. I'm giving you too long of answers. I don't know how much time we have, Campbell. So
yeah, sorry, I was hogging the mic.
Yes or no, but it's hard for me to do that.
Okay.
Yeah, thanks for that. I guess you touched on, your last point touched on my question. So, after Nevada Copper, you would have looked at lots of opportunities. So why did you pick this? And I heard you just mention you worked on the permitting here previously.
Yeah, no.
So how did you come across this project, and why did you pick this project over other?
Very clear about that. Nevada Copper arguably had a big Russian oligarch that stepped in, Powell Investments. You guys were familiar with them. I retired from Nevada Copper in 2018. I will be very frank on this point. Got a bit restless. Looked up at what was happening at Copperstone, and one of the big shareholders of American Bonanza that ultimately rolled his position into Kerr. We started talking about it because I was interested in Copperstone. I've always felt there was a lot more there. And I'm not critiquing what was done historically, but I always felt there was a slightly different strategy that you could adopt. And so he asked if I would have any interest in maybe stepping on as a director. And I said, by all means. I just think there's a lot of opportunity here. I'm not going to say that it's a tier 1 5 million ounce deposit, but my gosh, with past production and what we currently have in front of us, it looks like a great opportunity. And fortunately for me, the then CEO, Claudio Trudeau, asked if I had any interest. We started talking. We have a very good working relationship. He's a very successful individual. It was really about, hey, we've got this project. You've got some history on it. Are you interested in stepping in? The answer is yes. And as I said too many times to count on this call anyway, it's taken me a bit longer than I would have liked, but that's the reality of our space, right? But it's what creates the opportunity, in my opinion, as well.
Yeah, and then for the upcoming, your pretty active program. So the recent financing, that was to fund an 8,000 meter drill program. Is that correct?
That's correct. And questions on dilution, and I get back to it, and understandably so. Some folks said, well, why did you raise that money? Well, we had money raised at the beginning of the year. Much of that was allocated towards a localized high wall failure that came in more costly than anticipated, up to about $2 million US. That was supposed to be used for a drilling program in Q2. We've got some of the money back from the insurer, but we're expecting to get the rest. But rather than sit back and wait, tough decision by the group. Good level of interest. We have good support from our banker, Haywood Securities, on that. They did a fantastic job for us, and we kind of made a decision that let's just get on with it. And albeit it's a bit of an ouch to raise money at 14 cents with a half warrant at 22. We did bring in a number of notable investors and shareholders, which is a good thing, that are going to work with us to see where we take this project. But that was really so we could drill the project appropriately along the lines as outlined, but also do the work that's needed to advance the engineering and do the initial met test work. And when I say advance the engineering, we have mining staff. We have 4,300 meters of underground development. We're not going to let it flood. We have to dewater it, and so we need people on site to comply with MSHA requirements. And so there's a burn that takes place on a month-to-month basis, but we've done I think a very good job keeping those costs down to a minimum. But that's the opportunity for us to let it flood and then deal with it later is not the smart move. You know, we've got equipment underground as well, so that's arguably what drove that financing. That gives us the runway that we need to execute, and I think that's the key point. And a company that doesn't have appropriate value add news, in my opinion, there's not much to talk about. So now you'll start to see, and I touched on it earlier, I'm going to do a lot more of these because of the fact that there's going to be things that I can speak to. You know, up until now, it's really about the work that we've done with heads down on the optimization, and very, very pleased with these results. But slide 19, my gosh, man, $20 to $30 million. You know, is there going to be some wiggle room in that? There always is, of course there is, but that's pretty darn significant for any smaller type company. And our valuation, market cap, less than $50 million, that's ridiculous. That's just ridiculous. And even from an enterprise value perspective, and that's why there's a lot of corporate suitors that want to see if they can do something with us, and we've come close, but you know, understandably so, we're not going to give it away. And you know, we were looking more at a growth platform that makes sense for all stakeholders, and we do understand very, very clearly what we have, and we understand the risk profile as well.
Yeah, and then would you look at adding extra drill rigs at site? Because is there one? You have one at site now?
There's a surface RC rig on site. We're bringing an underground core rig. We would like to add another rig. I'd like to do it in the shortest timeline possible. But you know, there's for many of you that do follow the space, the drill rig availability has become more challenging than it was for the longest time, simply because of the greater level of activity, which has driven delays with many companies that are trying to drill their programs out. Fortunately, we have a rig that we had a commitment on a while back. But also the impact on assays. Assays should usually turn around in 2 to 3 weeks. They're giving us a timeline of 4 to 6 weeks. So of course, we do have a relationship with the assay lab and pushing them as hard as we can. But that's arguably out of my control to a certain extent. But trust me, we're on it as best we can.
Yeah, I mean, we're hearing from lots of people delays in assay lab, and it's tougher to get drill rigs. But how about staff? How are you finding getting staff at to the site?
Well,
with new people you're hiring or locals in the nearest towns, etc.
Yeah, no, I think that if you look at the American Southwest, you know, Arizona and Nevada, I mean, there's a lot of good mining professionals, and when you look at this project, anyone that really wants to be involved with something that is seriously going to move forward appropriately will look at this project, so we benefit from that. And there's also communities nearby that are nice enough to live in, you know, from Parker to Blythe to even Scottsdale. It's an hour and a half drive. It's an hour and 45 minutes, outside of Scottsdale. So, you know, most mining professionals have families, and, you know, anytime they have to relocate, they want to relocate to an appropriate location. And so I think with the proximity that this project has, I mean, it's nearby Quartzsite. Quartzsite's not a place that anyone would really want to live in. I shouldn't say that, but there's enough nearby locations that are awfully nice to live in for families. And the mere fact that this is a project that's got a lot of opportunity in terms of not just an early stage drilling program that's loosely defined. It's really about a program that is adding value in the short term with the view of taking it into production. So that will drive a lot of mining professionals to it, you know, as long as they can see that there's an appropriate pathway. That if anything is something that we benefit from, as opposed to some of these earlier stage companies that come out with what are very early projects that have limited drilling and loosely defined resources that are arguably 10 to 15 years away from production. I mean, understanding production too is a key point. It takes a long time to get a project to this stage, and the mere fact that you can get there on a funding package within 12 months was really one of the biggest things that I looked at. You know, I knew that there were some issues with it, relatively speaking, in terms of previous numbers, but we've done under Martin's direction and Dave Thomas, done a very good job getting it to the next level, you know, appropriately, so we're comfortable with what we put forth. But it is forward looking, I will say that, you know, as the disclaimer points to, if I'm going to talk to a prospective investor or current investor, they might as well understand what I'm looking at. This is what I'm looking at. This is why I'm very, very comfortable. And this is why, you know, I've written some pretty sizable personal checks, more so than your typical CEO.
Yeah, and then just one last question from me. You mentioned recent financing. You got some new shareholders. Like, have you? I know travel is tough since March, but have any of your larger shareholders completed site visits?
Some of them have, by all means, but predates COVID, of course, as you'd expect.
Yeah.
I mean, the quarantine period, even myself, I haven't been to the project in 2020 for obvious reasons. Well, early part of 2020 I was, but post-COVID, not at all, for obvious reasons. But Dave Thomas and Martin are based in the US, so that gives us a good level of flexibility, and the mining personnel are on site.
Right. Thanks for that, Artie.
You mentioned the processing infrastructure at the project, and the capex is for the milling is between 2 to 4 million. That's the results of the refurbishment study of the current infrastructure in place.
On the mill side, that really is bringing in a group such as FL Schmidt and going through it in detail and letting them spend time at site. And they came back to us with a pretty comprehensive estimate of what it would cost. There's other groups as well. The range really gets back there. We're really simply looking at a restart. There's a restart on the flotation side and shipping out a flow con. You know, anytime you're shipping out a flow concentrate, it comes with its complexities from an offtake perspective, and there's challenges, but could be beneficial. That's how the project was initially permitted. That would be less than 2 million, but you know, modifying the circuit appropriately so that we can actually get to a doré and or whole ore leach type scenario is what gets you to the higher amount. I'm always going to hedge my bet on the numbers. You know, I say 2 to 4, is it 2 to 5, but it's going to be in that range. But we have had, you know, FL Schmidt's one of the best process groups out there, and that further supports my comment. You're not going to get that level of detail from a third-party engineering group that is attempting to put forth a feasibility study. It just doesn't happen. We don't get a group like FL Schmidt to come to site for a number of days on several occasions to come up with firm numbers because they want the opportunity. But you know, as you'd expect, our guys, we're going to look at that as an opportunity as well as some other groups that can potentially help us with that. But they're one of the, I'm using them as one of the bookends. It gives me sort of a level of comfort. And that also gets back to, and it's not trying to be cavalier or oversimplifying it, but you know, what are your biggest cost centers? What I like to do is look at the model, and it's mine development and this restart of the mill. The tailings facilities in place, it's got expansion capabilities. We have to look at year 3 to 4 when that starts. That's factored into our model. So that drives much of this, right? And if you have a chance, go to the website. We're going to probably look at updating the website appropriately at some point. But if you go to the website, there's a flyover of the project. That'll give you a good representation of what the project looks like. And you'll find that there's more than just a drill rig on site. You know, it is a past producer. It's got an assay lab. It's got site facilities. And you go back even to the last slide. I think that's, you know, on slide. Well, the last slide didn't have a page number, unfortunately. The last slide on the PowerPoint, you can get a good flavor for what exists on site. And there's a separate visual that'll show you the pit. Well, anyway, I'll let you source that out, but there are visuals that'll show you that in greater detail. Unfortunately, slide 5 will give you a sense of some of the drilling that was done near the open pit. That predates our current program, if you will.
Thank you, Campbell.
Yeah. One last question. How can you protect yourself against the hostile? Have you thought about that? As you become too good to be true.
Once again, I'm going to sound a bit arrogant on this one. Look at the share structure and what that looks like. And so if you look at the 30% plus the convertible feature that's held by the chairman and vice chairman, that gets us probably close to 40%. And then you've got other funds and groups that are, you know, close enough to the company. So with that said, though, if done at the right price point, that's something that you always have to consider, right? I mean, I wouldn't suggest not. I do believe that understanding a little bit about the capital markets, leverage drives this, right? And so if we can leverage this into a bigger growth platform that gets you to $500 million, you're going to drive a completely different audience and a different valuation. You just do that. And so right now, you know, if we can present a platform that is our production plus other production that gets us close to 200,000 ounces within a short period of time, that makes for an awfully attractive target. And that's to everyone's benefit. So it's value driven. I mean, there have been a couple of groups that wanted to do something with us, but we couldn't get there on valuation. Just couldn't. You know, when I say valuation, can't do it at 20 cents. I have no desire to do it at 20 cents. You know, just no desire. Period. And so it's really about that opportunity. But you know, the farther we get along in this cycle in terms of ounces that we add and the ability to demonstrate that it's a near-term producing situation, I think you'll start seeing the valuations change. And a different audience will come into it like it always does. You know, there's going to be some turnover as you'd expect.
We've reached the top of our hour and want to thank everyone for tuning in. We'll be queuing you for some feedback. We'll appreciate it. And I promise you it'll get straight to Giulio. Do follow Kerr Mines on LinkedIn and for that matter, Amvest Capital on LinkedIn. And Julie, with that, if you could help us close with your statement for the end of the show.
Statement for the end of the show. I think I covered off all the points. So
we're gonna go out and buy some stocks tomorrow.
But I will
last
say
thing we hear.
Sorry, Campbell. I will say I think it's an exceptional opportunity. It hasn't run like many of these other gold stories in the earlier stage of development. I think if anything, there's a benefit that some of your listeners will have by way of paying attention to what we do on a go-forward basis, because the leverage on share price alone, and what we see from a multiple and EBITDA and cash flow speaks for itself. And so, great opportunity. There'll be some research that comes out that targets a significantly higher share price in the 40 cents to 50 cent range. So if some of your listeners want access to that, maybe they can just send their emails along. I don't know exactly how you work it on your side, but happy to flip that research along to them appropriately.
Okay, great. Thank you. Good day and good night, everyone.
Thanks, guys.
Thanks.
Thank you.
Thank you.
All right.
Thanks.
See you
Good
later.
evening.
Bye.